there is a process that I encourage everybody to go through when they are pricing a property, and in fact create a little free course. So it's I'll put the link in the show notes. It's homebuyeracademy.com/free course. And that is to teach you the comparative sales process, to look at comparative sales and how to assess them against the property that you're looking at buying. And there is a process to that. When we put together that course, the market it was actually pretty flat, or maybe even falling when we actually originally recorded that course. And so what we need to do is upgrade it with a module for how to index for market movement, because that's what we do in our business. And that is that if a property sold a month ago, we've got to think, well, how's the market moved since then to now, or 2 months or 3 months or whatever, which is what you're alluding to there. And I actually use core logic figures now. I used to try to do it suburb by suburb, but medians are notoriously unreliable. If you've listened to enough of our podcasts, you'll know that. I end up working out that the actual using the core logic data on a monthly basis for the whole of Sydney as an index figure is actually more reliable and more robust for us than any other method that I've tried over the years. So that's what we do. And I literally break it down so there's a monthly index figure for units, dwellings and houses. I use the dwellings ones for townhouses, I use the unit ones for units, and I use the houses one for houses. And that's how I factor up past sales to sort of equivalent today's price. But that's not where it stops, right? Then I have to say, right, well, I then also track because we are looking at typically A-grade assets, they are going to be more competitive. They always are. Than B, C, D. Even though C's are competitive in a hot market, they're not as competitive as an A, all right? So there's a premium to be paid, and over and above where the research might indicate, and that's painful, but we have to quantify that premium. And so in my business, I actually do track that. I track how we price properties, and I track the sale price, whether we buy it or whether somebody else buys it. Now, this is quite scientific compared to what the average buyer is going to do, but it sort of goes to what Chris is saying. You sort of have to put in a buffer that you're prepared to live with. So I would say when it's really hot and we're going to auction and it's an absolute A-grade property and it absolutely suits our clients' needs really well, and they're scarce and they're very hard to come by, I would encourage them to consider putting 10% on top of the upper level of the range in which we've scientifically worked out it should be, in inverted commas, worth, right?
Yeah.
Because that's also buying in a couple of months, a few months growth. That's actually prepaying for, say, 3 months growth in last year's terms, because we know it's scarce, we know how well it suits their needs. So you do have to go through this process of assessing the asset for its own merits, regardless of your needs, and also how well it suits your needs.
Yeah.
And that's the bit that people throw out the window in a hot market. That's when they lose all pickiness and they get super fussy, or they just they pay whatever for anything because they've given up. They've got decision fatigue. So there is a place and a time to what you might want to call it overpay. And some buyers agents, I tell you, will encourage you just to part with your money, because yes, you have to be the highest bidder to win. But the fact is, you've got to be very strategic in which ones you choose to be the highest bidder on. And that's the important thing.